Welcome back to our MPC special broadcast. It's time now to get analysis following that Reserve Bank announcement. And we're joined in studio by Nicky Weimar, who's the Chief Economist at Nedbank. And hopefully in a little bit, we'll also have an economist from Liberty joining us. However, Nicky, let's start off with you. And we were remarking off air how pretty much most economists got it wrong, considering that going into this meeting, we were expecting 25 basis points. Take me through, how he surprised you here, and perhaps your rationale on why you think he went for 50 as opposed to the 25.
I think the surprise is, that we also, like everybody else, and we've been saying it a long time, though, is that you would have another 25 basis points. If we looked at our models, 11% seemed like a good place for prime to peak. But I think there are a couple of factors that might have driven this decision. The first thing we've seen with the Federal Reserve continuing to hike interest rates, despite the instability we may have seen in the US banking sector, the reality is that the margin between our interest rates and their interest rates is narrowing. And that's really our compensation to investors for taking the risk, the higher risk of putting their money in South Africa. And I think it has played a role in the rand's extreme weakness and volatility. On top, of course, the grey listing and the load shedding issues and the very poor growth rate we have on the table at the moment. So I think all of those factors is something that can't be ignored, and it's very visible in how the currency is weakening. And as the governor pointed out, with a lag effect, the weaker currency is contributing to higher food inflation. And food inflation has been probably the most disappointing part of the February inflation numbers, because it's really escalated further. It's now over 14%, which for the vast majority of South Africa's population, that is a very, very painful pill to swallow every single month, in terms of what it does to your disposable income and how rapidly it erodes your purchasing power. So I think that is a key factor behind their decision. And then finally, it is the fact that we've seen an increase in inflationary expectations. And really, the trick the Reserve Bank has to try and pull is to convince people that they can keep inflation stable. And if expectations of inflation is rising, then that has ripple effects for wages, it has ripple effects for pricing behavior. And I think that might have been the sort of final straw that broke the camel's back in favor of a 50 basis points hike rather than a 25 basis point hike.
So let's talk a little bit about the voting split. I mean, 3 voted for yes, 50 basis points, and 2 said 25 basis points. And it was quite interesting when I was doing a chart analysis on our previous show. A lot of what was expected from a Bloomberg survey was that economists were expecting 25 basis points and that it would be unanimous across the board. And oftentimes what has been spoken about, at least over the past day or so, is that we are at the end of the rate hiking cycle. Do you buy into that? Does the SAB, does that justify that 50 basis point? Does it do enough to say that we're at the end?
I think that a lot of it depends. We're very close, in my opinion. We're very, very close. If they went with 25 and you saw further interest rate inflation pressure coming through, and you saw the Fed hiking even more increasingly going forward, and the margin between our rates and their rates narrowing even further, and the rand coming under more pressure, then they would have had the option to go with another 25. Now they've moved with 50. So they've already moved interest rates to levels that is well above pre-pandemic levels. Inflation is also hovering above pre-pandemic levels, but it is anticipated to come down. So I would say that this would probably, if we had to go and adjust our forecast, we'd probably see this as the last hike in the cycle. But of course, it all depends on what happens over the next 3 months. And I think that whatever happens to US interest rates will have a very important bearing, because it impacts on the rand.
Nicky, the Reserve Bank governor spoke a lot about what is happening on the state side as it relates to the Federal Reserve. How complex has monetary policy become for Fed Chair Powell, given what we've experienced at least over the past 2 weeks with what's happening with the regional banks in the US?
I think it is quite complex because a central bank has essentially got two jobs, right? They've got to maintain financial stability, which is maintain the stability and the integrity, really, of the banking system. And at the same time, they've got to ensure that we have low and steady inflation. And these two are actually in conflict with each other at the moment, because obviously if you've got financial instability, that tends to be deflationary, and it tends to choke off credit to the economy. And therefore, the only way that you can ease that sort of pressure is by cutting interest rates. But if you have sources of inflation elsewhere in the economy and you're actually now almost fueling demand, you're making your inflation problem worse. So I think that's kind of the conflict that they're stuck in at the moment. However, it all depends on whether they can keep the trust in the banking sector. And that's an unpredictable beast. There's no denying that. But as long as the public believes that their money is safe, then you won't necessarily have this situation where deposits is taking flight from your smaller to your mid-sized banks to your larger banks or to money market funds where they believe they'll get a higher return. So I think that is probably the trick here, is whether they've done enough, pumped enough liquidity in, offered enough guarantees for deposits to ensure that they've got that situation under control. It's far too early to say, but it looks like the market is starting to believe that they've done enough. Then their focus can shift back to inflation. And there they pointed that there was a risk that they might need to move one more time. And then that brings the Reserve Bank story back into the equation as well.
Because I've been wondering whether, given what's happened in the US side, does I suppose, call it the curtailment of credit, conditions, particularly in the banking sector, does that do a little bit of the job for the Fed? Because they still need to come back down to 2%. And sometimes I feel like it might be a bit of an imaginary number. I don't know if they're going to get to 2% at this rate. I mean, how are you seeing it?
No, they'll get to 2%. The question is just at what cost? So, I mean, yes, it does. It is if a bank fails, but for it to do the same work as interest rates, it has to be a significant crisis. It can't just affect, customers in a small portion of the economy. It's got to be a sort of generalized choking off of credit to the system. Then it is the same effect as raising interest rates, slowing the economy down and reducing the demand for credit. You're quite right. So it's almost equivalent to a further interest rate hike. But again, it has to be broad-based. And at this point, there isn't any evidence to suggest that it's having that effect.
Nicky, what I wanted to talk about was inflation targeting. I mean, a lot of the times, I think the debate has at least started to gain momentum last year when we were looking at where inflation needs to be and where we're currently sitting, especially when you look at things from the US side as well. Should inflation targets, be set higher? And then also, should we have some kind of flexibility when it comes to the implementation of inflation targeting?
I think, unfortunately, the dynamics of inflation doesn't work that way. If you're going to continually treat a target as something that is flexible and that you can move around, then no one's going to believe that you are serious about actually meeting that target. And in order to anchor inflation, in order to ensure that you have stable and steady inflation, you need people to believe that you will ensure and enforce that target. So I think that is the problem with that argument of having flexibility. In terms of the argument saying that because you're in an emerging market, you want to promote growth, you have a wrong road ahead of you in terms of development, you might have particular issues like high unemployment, inequality, high levels of poverty, and therefore you should be willing to tolerate higher levels of inflation in favor of stronger economic growth. There might be situations where you can have that argument, but it really also depends on what your peer countries are doing, countries with very similar dynamics than yours. And in that score, our inflation target is actually quite high already, all right? That's the first thing. And then the second thing is that ultimately, in South Africa's situation, you must understand why we're not growing. Are we not growing because interest rates are too high and therefore there's very limited demand for credit and therefore as a result of that there's just very little growth in the system? Or are we not growing because we don't have electricity and we don't have proper road, rail and port infrastructure to enable greater competitiveness? What is the reason we're not growing? And I would argue it's the latter rather than the former.
Nikki, when you look at your GDP growth outlook, to what extent has that, changed dramatically, or you've reassessed it dramatically, given the background of this intense load shedding?
Oh, we've revised it down quite a lot. We had a fairly weak growth rate to begin with for this year of 1.2%. The argument back then, last year when we had this particular number, was that higher interest rates would slow down the economy. But with load shedding, that of course changed the picture completely, and we've had to revise our number down to 0.4%. We sort of split between 0.1 and 0.4. A tiny little change in your assumptions and your models suddenly take you to 0.1%. The Reserve Bank is now at 0.2, so it's pretty much in the range that our numbers would kick out, but we've opted for the 0.4% growth rate for this year, which is very weak, and that is really based on the fact that in January, we actually had stronger than expected outcomes in mining and manufacturing, retail sales, wholesale sales, and as a result of that, it sort of bumped the number up a little bit.
I've been curious, when it comes to the lag effects of monetary policy, what would you be paying attention to as those lag effects start to take hold in the economy?
Well, I think when it comes to monetary policy, a key indicator of when you are starting to see the effects of it come to play would be in your credit numbers. So credit is always a good indicator, especially your sort of more short-term credit, transactional, your sort of volumes of transactions. That gives you a good indication of when interest rates are starting to bite. Also very often prices, because prices respond very quickly to what is happening in terms of demand. So the moment we start seeing companies discount more in order to move volume, then you know that consumers are taking strain, their income is being squeezed, whether it be from the fact that perhaps wages haven't fully compensated for last year's rise in inflation, or whether it be from higher interest rates. That's when you'll start to see it. But credit is usually a pretty good indicator. Now, on the credit front, it's been pretty robust, and it's only the last 2 months or so that we've seen some moderation. But generally speaking, there isn't overwhelming evidence that is putting at this point, interest rates are putting immense pressure on consumer demand.
So we've rather had 50 basis points from the SARB this afternoon. The future rate, I suppose, or rather future path of policy rates for South Africa going forward, what would that depend on if, say, we were to look at one of two scenarios, either a pause or potentially, another increase? I'm so scared to say it, and it might just scare the viewers.
Yes. I think we've got to sort of look at it this way. We're in a very uncertain situation. I think especially in the first half of this year. The outlook globally will improve, I think, a lot for South Africa once the US Fed has sort of gotten interest rates to their peak levels. So once the peak in US interest rates are behind us, then I think global risk sentiment will turn. Investors will start to look for opportunities elsewhere. You'll probably see the rand stabilize and pull back because it is quite undervalued at this point in time. And as that occurs, of course, our interest rate outlook will also stabilize. But I think at this point, it's still very uncertain. So I would say over the next 3 months, you still have upside risk to interest rates. But if you do, it's very, very marginal. And my sense is that this might be the last rate hike in the cycle.
Yeah, because I was going to ask, perhaps we should borrow from, the US side in terms of language, when we talk about Fed speak, and we're talking about a so-called Fed pivot or no pivot, or a landing or no landing, or whatever the case may be. But from the side of that argument, we're looking at, perhaps not even an argument, but we talk about the tone of what comes out of these monetary policy speeches. This tone, hawkish, or how are you seeing this one?
Yeah, I think it's quite hawkish. I think the action itself was hawkish, going with 50 basis points. That is a hawkish move. Because it also means if anything affects inflation going forward, and it surprises on the upside, you're going to be under pressure to hike even further. Where if you moved at slower increments and smaller increments, you'd still have that option to move interest rates without lifting your absolute level of interest rates up too dramatically. So yes, I would say this is definitely hawkish.
Do you have to hike until something breaks or until something gets to a point of breaking?
No, I think the idea is not that you hike until something breaks. I think that's the very thing they want to avoid. So they would be aiming to see, I think, concisive evidence of inflation decelerating.
Okay, so before we, wrap up the conversation with just a couple of minutes left, the things that you'd want our viewers to pay attention to, the stuff that you're looking at on your screens when you come in to the office every day, especially as it relates to the South African economy, from now until the next meeting, because we always talk about data dependency. What are you going to be looking at?
So I think the key for them to look at would be what happens to food inflation. And there the big unknown is the likely impact that load shedding is, the price effects of load shedding. The fact that companies have to run generators, buy fuel, run them for longer periods of time, that is raising the cost of production. And clearly at this point, if we look at food inflation, companies do feel that they have the ability to pass cost increases on to the consumer without it hurting volumes too much. So food inflation is certainly something to look at. Core inflation, whether that's continuing to rise, whatever the US Fed does, if they do not hike again, then I think we're in a much safer space. And if the rand stabilizes, then we're also in a much safer space, and we can potentially avoid another rate increase.
All right, Nicky, on that note, let's leave it there. Thank you so much for your time. That is Nicky Weimar, who is the Chief Economist at Nedbank, giving us her perspective, unpacking that policy statement that we did receive from the South African Reserve Bank, hiking by 50 basis points.